Hi, I'm Anthony Diosdi. I'm a tax attorney in San Francisco with over 20 years experience in international and domestic tax planning and tax litigation. You can find me at sftaxcounsel.com. Today, I'm talking about what foreign investors need to know about the U.S. estate and gift tax. So, before we kind of get into the nuances about what foreign investors in the U.S. need to understand about the U.S. estate and gift tax, let's talk about generally how this operates. What is the U.S. estate and gift tax? Because a lot of investors coming in from outside the U.S. have no idea about this tax, and it's a transfer tax. Some foreign investors from Europe might have an idea how it works because Europe has a number of transfer tax that operate somewhat similar to the US estate and gift tax. But the way it works is this way. In the United States, an individual is allowed to basically pass on at their death $13.99 million of assets without their estate being subject to the estate tax. This is why it's called the estate tax. The estate tax itself is assessed against an individual's estate. So when someone dies, and the law provides that individual's assets will go into an estate, debts of the estate will be paid first, and then whatever's left of the estate will pass on to the beneficiaries. So, under federal law, $13.99 million, at least as of 2025, can be passed on to the beneficiaries or whoever the individual who's died decide to pass on to their beneficiaries. We also have a gift tax. And what a gift tax is that during a U.S. individual's lifetime, they're allowed to gift away up to $13.99 million of gifts without being subject to the gift tax. Now, the estate tax and gift tax work together. Each and every single year, a U.S. person can give away up to $19,000 without having to file anything with the Internal Revenue Service. Anything above $19,000 to an individual in the form of a gift, that U.S. person has to file a gift tax return. Does it mean that they pay a gift tax, that they have to file a gift tax return? And the reason for filing a gift tax return is to put the IRS on notice about how much that individual ate away at that $13.9 million lifetime exclusion from the gift tax. So let's just say somebody during their lifetime gives away $3 million. That $3 million will be reduced from that individual's $13.99 million lifetime exclusion from the estate tax. So in this example, if someone gifted away $3 million during their lifetime, then upon their death, they can still give away $10.99 million without being subject to the estate tax. At the end of 2025, if Congress doesn't act, and we'll get into this a little later, if Congress doesn't act, that exclusion will drop from 13.99 million down to 7 million. That's a proposed number, nobody knows, but that's what it looks like is going to happen if Congress does not act. Now, if you are a foreign investor and you don't reside in the US or you're not domiciled in the US. And what I mean by domiciled in the US, what I'm trying to say is that you do not intend to make the US your home. And if you don't intend to make the US your home, then you're still subject to these transfer taxes, these estate and gift taxes. However, the threshold is different for you. If you are a foreign investor or a foreign person that has US assets and you die, you do not have that $13.99 million exclusion. Instead, your exclusion is only $60,000. So upon your death, if you have US assets, then you are only allowed a $60,000 credit, and anything above $60,000 of your US assets is subject to the estate tax. And that estate tax could be as high as 40% of the value of that US asset. You could also be subject to a gift tax. Now, let's just say you gift something. You're a non-domiciled individual. Let's just say you own a house in California, and let's just say the house is worth $1 million, and you gift that to a family member. Gift itself is subject to a gift tax, but unlike the estate tax, there is no $60,000 threshold. You are basically subject to a gift tax up to 40% on the value of that entire transfer. Now, there are certain ways to kind of potentially mitigate or eliminate your risk to the estate and gift tax. One way of doing it is to potentially put your US assets into a trust or put your US assets into a partnership or a corporation. And you could transfer your assets during your lifetime or upon your death to individuals that you designate as your beneficiaries of that property. The reason for this is that although a foreign individual who invests in the US is subject to an estate and gift tax on their US assets, and the legal term is US situs assets, if the US situs asset is either in a corporation or a trust or a partnership, you can avoid potentially in certain situations the estate and gift tax. There is a little bit of interesting play with this because the estate tax taxes all assets that are US situs. So if you have shares in corporate stocks that are US situs assets, US, let's just say it's a US corporation, it's subject to the estate tax. However, if you have a share of corporate stocks or an interest in a partnership and you choose to gift that to somebody, that's not subject to the gift tax. So, what a lot of people do for planning purposes is they will take US situs assets like a parcel of property or something else that has value, and they place it into a domestic corporation or they place it into a partnership, and they use that, they transfer those assets to avoid the gift tax. Now, I'm oversimplifying this. There's a lot that needs to be taken into consideration. I'm going to make a future video discussing another tax called FERPTA, which should always be taken into consideration when you are planning for the estate and gift tax. But that's something to kind of keep in mind. You can't just go ahead and take an asset and place it into a US corporation or a US partnership. Because if you do without planning, that transfer itself could still be subject to a FERPTA withholding, which could be up to 15% of the value of that asset. The same goes if you try to place that asset into a domestic trust. You could also be subject to a FERPTA withholding. And in some cases, you could also be subject to an income tax consequence. How do you hold assets in a partnership or a corporation to try to avoid the estate tax? Because if you pass away and you're holding the asset itself, or let's just say it's a home. Let's just say it's home here in California. And let's just say you place that home into a US corporation. And let's just say prior to your death, you didn't transfer those shares of that corporation to family members. If you do that, what could wind up happening is, like as I mentioned, since that's a U.S. corporation, that could be subject to the estate tax. But sometimes what you could do is you could hold an asset through a tiered entity. It could be a tiered corporation in that it has a foreign parent, and the foreign parent itself holds the US corporation. Same goes as well with a partnership. You could have a foreign partnership that holds the domestic partnership, and this way it could be used to avoid both the US estate and gift tax. Careful planning needs to be done with this as well because there are potential really negative tax consequences when you use a foreign entity to hold a US entity. This come under the so-called inversion rules. So anytime you have someone making or planning to transfer an asset into a multi-tiered entity itself, the inversion rules need to be taken in consideration. And the other needs to be taken in consideration as well is if you're transferring the asset to US beneficiaries, the US beneficiary itself, you never want to gift to them a share of a foreign stock or a share of a foreign partnership, because there is some negative potential consequences that could wind up coming about with the so-called CFC rules or the PFIC rules. So these are really careful things that need to be kind of thought out before it's done. And I'll wind up making future videos to kind of go into this in more detail. Another way of potentially avoiding the U.S. estate and gift tax is if there's a estate and gift tax treaty. Now, we all heard of income tax treaties, but with the exception of the income tax treaty that the U.S. has with Canada, income tax treaties doesn't really do much for estate and gift taxes. Now, we have a number of estate and gift tax treaties with a number of countries, such as the United Kingdom, such as France, Japan, and a lot of times these estate and gift tax treaties can be utilized to avoid the US estate and gift tax. But it all depends on the actual treaty itself. It all depends on what that treaty itself winds up saying. A lot of times what a estate and gift tax treaty will allow a foreign investor to do is they allow the foreign investor to be taxed as if they were a US person. And they'll allow them to kind of take that $13.99 million unified credit rather than only being subject to that $60,000 credit for purposes of the estate tax. That is one way of utilizing it. Another way of utilizing it, and this all depends on the facts and circumstance of the case, sometimes you'll have a foreign investor that will try to invest in the US and they'll come from a country that has a very high inheritance tax, such as the United Kingdom or such as France. And sometimes the estate and gift tax treaty itself will allow the foreign investor to be taxed in the United States for purposes of both the foreign country's inheritance tax and the US estate and gift tax, because with that $13.99 million exclusion, if through the treaty itself you could establish domicile in the US through the treaty, which many times abrogates the US rules for domiciliary purposes, it might be beneficial. So if you are a foreign investor, you should carefully, and if you're buying any type of business or if you're buying real property in the US, which is often the case, always consider the US estate and gift tax. Consider your planning options first. Look to see if there's a estate and gift tax treaty that can be utilized. If an estate and gift tax treaty cannot be utilized, look to see what type of structure that could be utilized to hold that US asset to avoid the US estate and gift tax, or at least minimize it. And the earlier you start planning, the better. It's always easier to place a US asset in an entity such as a corporation or a trust or a partnership when you're first acquiring that asset than to try to go ahead and do it later on. It can be done later on, but it's just a lot more headaches and a lot more planning that needs to be done. A lot more considerations need to be taken. A lot more of the taxes need to be considered, such as income tax, such as your potential U.S. beneficiaries. Now, I'm going to finish this discussion on one final topic. There is talk right now about the estate tax being eliminated. There's talk in Washington in both houses, both in the House of Representatives and both in the Senate, of eliminating the U.S. estate tax, not just for U.S. individuals, but also for foreign domiciliaries. The idea is that if you eliminate the estate tax, that you might have more investment in the U.S. The talk about eliminating the estate tax is just that's only on the estate tax. There is any kind of draft bills I've seen, it does not mention an elimination of the gift tax, but the estate tax, there is debate right now in Congress about eliminating it. But I will say that there's a very thin margin in the House of Representatives on the Republican side, and the Republicans are the ones trying to basically eliminate the U.S. estate tax. So it's just talk right now, but it's also something that anybody who's considering investing in the US should also keep an eye on right now. They should definitely keep an eye on what potentially may happen with the US estate tax, and also make sure that if you are investing in the US right now, you are still planning for it, because nobody knows what's going to wind up happening, if the estate tax will be eliminated or not. This discussion came up, I believe, originally about 10 years ago. There was a lot of talk about getting rid of the estate tax. I think you had a Republican Congress at that point in time, and it did not wind up happening. So we don't know, but it's something to definitely keep in mind. Keep your eyes on, and definitely consult with a tax attorney who understands these changes in the laws and changes that can potentially impact you, and also potential planning options. So the information we discussed today regarding the U.S. estate and gift tax is for educational purposes only. This is not meant to be tax advice or legal advice. If you are seeking any kind of advice regarding the U.S. estate and gift tax, you should speak to a qualified tax attorney, preferably an international tax attorney who understands this topic and can go through your specific facts and give you advice custom tailored to you.